Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
All right, so today we're going to do a deep dive into private equity, but with a bit of a twist.
Yeah.
We're going to be dissecting the CalSTRS Private Equity Performance Report for the fiscal year 2024. But instead of getting lost in the world of, billion-dollar mega deals, we're going to zoom in. We're going granular. We're going to be focusing on the lower middle market. So think businesses valued between $2 and $50 million.
Yeah.
Hidden gems
Yeah.
with massive growth potential.
It's funny you should say that, because what we find fascinating about that segment of the market is that it often flies under the radar. But when you look at the CalSTRS private equity portfolio, it represents a significant portion of it.
Yeah.
And, it makes you wonder.
What is driving this interest?
Well, that's exactly what I found so interesting when I was looking at this report. It really reveals that CalSTRS has committed billions of dollars across hundreds of funds, targeting specifically this market. And you see names like Acon Equity Partners, Advent International, even some CalSTRS branded funds in the mix. It's a really bustling marketplace. So why the draw for a giant like CalSTRS? Well, you have to think about it this way. Large pension funds like CalSTRS, they need a diversified portfolio. And they need that portfolio to generate consistent returns for their beneficiaries. The lower middle market might just offer that sweet spot because, you have the potential for higher growth as opposed to established giants. But there's less risk than betting on early stage startups. So it's almost finding like a balance between risk and reward.
That makes a lot of sense.
Yeah.
But here's where I think things get really interesting. This report reveals that performance in this market can be a bit of a roller coaster.
Yeah.
Some funds posting incredible returns. Others, well, not so much.
Absolutely. The range of internal rates of return, or IRRs as they're called, it's vast, some exceeding 70%, while others are dipping into negative territory. So, for example, you've got Blackstone Capital Partners, the 5, LP, which started back in 2003. It boasts a 35.95% IRR. But then you look at Advent Central and Eastern Europe, IVLP, which started in 2008. And it's sitting at negative 9.47%. Huge difference.
That is a massive swing.
Yeah.
So what could explain such a difference in performance? Is it just the luck of the draw? Or are there specific factors at play?
Well, it's definitely not just luck. There are a number of factors that contribute to that performance gap. But one of the most crucial elements is the expertise and strategy of the fund managers. Are they skilled at identifying promising businesses, negotiating favorable deals, and then adding value post-investment? I mean, you mentioned Advent International earlier. They have a strong track record overall. But that Eastern Europe fund shows even the best can stumble.
Right. It really highlights that. Even with a big name, not every investment's a home run.
Precisely. And then you've also got the inherent risk associated with specific industries. So, for example, tech might offer explosive growth, but it also carries a higher chance of failure.
So it sounds like picking the right industry, or at least understanding the risks associated with it, is pretty crucial.
Absolutely. And then, of course, you can't forget the impact of the overall economic climate. A fund launched during a boom might end up overpaying for assets, while one launched during a downturn could find bargains. It's all about timing, navigating those economic waves, like that 2008 fund that we mentioned. The timing was far from ideal.
It really does sound like picking winners in this market is a complex game, not just about throwing money at any lower middle market business. So what are some of the key things to look for? What should our listeners be focusing on if they're interested in this market segment?
It requires meticulous due diligence, understanding the target industries, and the ability to anticipate market shifts. But looking at this report, I think a few things really stand out. Let's start with specialization.
Specialization, you mean like focusing on a specific industry niche?
Exactly. It seems counterintuitive. But narrowing your focus can actually be an advantage. Let's take Francisco Partners as an example. The report lists multiple Francisco Partners funds, all laser-focused on technology. Some of these have generated exceptional returns, like Francisco Partners Agility, LP, with an IRR of 84.71%.
Wow, 84.71%. Clearly they're doing something right. It seems counterintuitive that a smaller, more specialized market segment could yield such high returns. What's happening here?
Well, that's the beauty of specialization. It allows funds like Francisco Partners to become experts in their niche. They build a deep understanding of the technology landscape, they develop a strong network, and they can spot promising startups that others might miss. This targeted approach gives them access to potentially higher return deals.
So it's like becoming the go-to expert in a specific field. You build a reputation, attract the best deals, and potentially reap the rewards. It makes sense, but it also raises another question for me. Does specialization always guarantee success? I mean, we talked about that Advent International Fund focused on Eastern Europe, and it didn't perform well.
That's a great point. Specialization is a powerful tool, but it's not a foolproof guarantee. You know, it's crucial to remember that even within a niche, there are various factors at play. The Advent example highlights that, regional factors, geopolitical risks, even the specific subsector within technology can impact performance. It's about choosing the right niche and navigating those complexities effectively.
So it's not just about picking any niche, it's about selecting one with strong growth potential and understanding the nuances within it. What else should our listeners consider when analyzing this report?
Well, alongside specialization, let's talk about timing. We touched upon it earlier, but it deserves a deeper dive. The report shows funds with vintage years ranging from the early 2000s to recent years. And you can see how broader economic cycles, like the 2008 financial crisis, have impacted returns.
Right, we saw how funds launched just before the 2008 financial crisis struggled, while those that came later capitalized on the recovery. But what exactly is a vintage year? Can you break that down for our listeners?
Think of it like planting a vineyard. The year the grapes are planted, the vintage year, influences the wine's character. Similarly, a fund's vintage year, when it was launched, shapes its investment opportunities and potential returns. A fund launched during an economic boom might face higher valuations and more competition for deals, while one launched during a downturn could find undervalued assets and less competition.
That's a great analogy. So analyzing a fund's vintage year can give us insights into the market conditions it faced at its inception and how those conditions might have influenced its performance.
Exactly. And it's not just about the initial launch year. The life cycle of a fund, typically 10 years, will experience various economic cycles. Some will be favorable, some not. Understanding this broader context helps us interpret the numbers in the report.
So it's not just about looking at the final IRR. It's about understanding the journey, the economic ups and downs a fund navigated to reach that number.
Precisely. So, for example, a fund with a 2008 vintage year might have a lower overall IRR due to the initial downturn, but if it shows strong performance in the later years, it indicates the fund manager skillfully navigated the crisis and capitalized on the recovery. It speaks volumes about their expertise and resilience.
That's a fantastic point. It adds another layer of analysis to this report. It's not just about the final numbers, but understanding the context in which those numbers were achieved. It's like reading between the lines of a financial story.
Exactly. And speaking of stories, this report is full of them. Each fund represents a unique narrative, a journey through the world of private equity. And by delving into these narratives, by understanding the interplay of specialization, timing, and skillful management, we can glean valuable insights for our own investment decisions.
Okay, so we've talked about specialization, we've talked about timing, and understanding the broader economic context.
Yeah.
Anything else our listeners should keep in mind when analyzing this report, especially if they're considering dipping their toes into the lower middle market? This has been so insightful. So we've got specialization, we've got timing, and we've got the overall economic backdrop. Is there anything else our listeners should be considering, especially if they're thinking about investing in this space?
Well, I think the most critical element, and it's something this report can only hint at, is due diligence. You can't just glance at a fund's IRR and call it a day. You've got to dig deeper.
So going beyond the numbers, what does that actually look like in practice?
Well, it starts with really understanding the fund managers. You know, what's their investment philosophy? What's their experience in this specific niche? Do they have a track record of successfully navigating different economic cycles? Past performance isn't a guarantee, but it can be a pretty strong indicator.
Yeah, it's like checking references. But for your money, right? You want to make sure the people managing your investments have the expertise and the temperament to handle the ups and downs of the market.
Exactly. And don't stop there. Look at their portfolio companies. Are they investing in businesses with solid fundamentals and a clear path to growth? What's their exit strategy? How do they plan to create value and ultimately generate returns for their investors?
So it's not just about picking a fund with a high IRR. It's about understanding how they achieve that IRR and whether their strategy aligns with your own investment goals and risk tolerance.
Absolutely. Due diligence is about asking tough questions, scrutinizing the details, and making sure you're comfortable with the risks involved. And remember, it's not a one-time event. It's an ongoing process.
So even after we've invested, you need to stay informed. Keep an eye on the fund's performance and make sure they're still executing on their strategy effectively.
Precisely. Think of it as a partnership. You're entrusting your capital to these fund managers, so you want to be confident in their abilities and their commitment to achieving shared goals.
Okay, so let's recap what we've learned from this deep dive into the CalSTRS Private Equity Performance Report. We've uncovered that the lower middle market, though often overlooked, offers a wealth of investment opportunities. Performance can vary wildly, so due diligence is absolutely paramount.
And we've seen how specialization can be a key driver of success, allowing funds to develop deep expertise and potentially access higher return deals. But it's not just about picking any niche, it's about understanding the nuances within it and making sure the fund managers have a proven track record in that specific area.
And of course, timing is everything. Understanding a fund's vintage year and how it navigated various economic cycles can provide really valuable insights into its performance and the skills of its managers.
That's right. And ultimately, it's about connecting the dots between all these factors, analyzing the numbers, understanding the context, and doing your due diligence to ensure you're making informed investment decisions.
So for our listeners who are ready to take action, what are 3 key takeaways that they can apply to their own investment journeys?
Well, first, don't dismiss the potential of the lower middle market. It might not have the glamour of mega deals, but it's a fertile ground for growth and returns.
Second, research is your best friend. This CalSTRS report is a fantastic starting point, but don't stop there. Dig deeper, analyze individual funds, understand their strategies, and scrutinize their track records.
And third, remember that timing matters. Consider the economic climate, both past and present, and how it might impact a fund's performance going forward. Are we heading towards a recession? Will certain sectors be more resilient than others? These are the questions savvy investors are asking.
Excellent advice. Well, we've explored the fascinating world of private equity in the lower middle market, uncovered some hidden gems, and gleaned valuable insights from the CalSTRS Private Equity Performance Report. But remember, this is just the beginning of your journey. Keep exploring, keep learning, and as always, happy investing.
Well, first, don't dismiss the potential of the lower middle market. It might not have the glamour of mega deals, but it's a fertile ground for growth and returns.
Second, research is your best friend. This CalSTRS report is a fantastic starting point, but don't stop there. Dig deeper, analyze individual funds, understand their strategies, and scrutinize their track records.
And third, remember that timing matters. Consider the economic climate, both past and present, and how it might impact a fund's performance going forward. Are we heading towards a recession? Will certain sectors be more resilient than others? These are the questions savvy investors are asking.
Excellent advice. Well, we've explored the fascinating world of private equity in the lower middle market and covered some hidden gems and gleaned valuable insights from the CalSTRS Private Equity Performance Report. But remember, this is just the beginning of your journey. Keep exploring, keep learning, and as always, happy investing.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.